Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to the Sparta Market Outlook, your weekly guide to what's really moving the oil markets. I'm your host, Rachel Williams. So look, this week we're going to tackle the so-called most telegraphed glut in oil history, asking whether the oversupply story is really as one-sided as it looks. We're also going to switch things up a bit. So instead of the usual run-through of data and headlines, we've put together a few current market trends under the microscope, the logic, the risk, and where they might come undone. So look, grab a coffee and settle in. Joining me today are June and Neil. Hi, both.
Hi.
Hi, good morning.
Cool. And let's get straight into what's making and breaking the headlines this week then. So first up, Neil, what's in the headlines and what's your take on them?
So the main one, I suppose, was the OPEC meeting at the weekend, and they did indeed hike by, 137 KBD, very nice exact number, which will obviously all hit the market exactly. And then there was OSPs as well. There's quite a bit of talk about it this week in the market, I suppose, trying to figure out why they didn't drop OSPs to Asia, what the hike means. I don't think we need to read that much into it. I do think there's an element of them projecting confidence. So it would be a kind of bad look if they decided to pause the hikes or reverse them. It would be a kind of bad look if they drastically dropped OSPs in line with where Dubai structure went. So I think it's more about projecting confidence. Of course, you can make up all kinds of stories around it. June, you probably have a different take on it. But in any case, for example, Arab Light in Asia is not necessarily overpriced as a result. It's got less competition from the Western arbed crude anyway, and against even the spot meg grades, it's not terribly overpriced. So it kind of works. On the other hand, in the West, they did drop the OSPs to Europe, and that makes sense to me. I think it actually still looks overpriced, and that's partly because the freight into Europe is high, and the things like Sverdrup in Europe are actually really cheap. So I don't think it's actually done enough in the West. And if you think that OPEC need to actually win market share, they probably don't need to, or they will need to target Europe as well. And in that sense, they probably haven't done enough. Right. The next one is oil on water, right? So talking about the glut, let's kind of figure this out. I'm actually quite surprised that Brent spreads are at the moment plus 60 cents. So that didn't go at the moment the way that I thought it would go.
Yep.
Which is fine. I mean, it's risk management and waiting for things to work out. I'm just trying to figure out what the bull play is or what's going on in pricing, because obviously the week was shaped by all these charts coming out about the massive level of global crude exports, the massive level of oil on water, and that's why, as you rightly said, Rachel, it's one of the most telegraphed gluts in history at the moment. And everybody sees these long balances, but at the moment pricing doesn't tell us that it's there. So I don't know, it's just worth investigating what the other side of the coin is, why people might be more bullish. One is, for example, a lot of the glut out of the Middle East is still in the hands of the Saudis. I've seen one chart this morning actually showing the loading pace from Saudi Arabia slowing down in October versus September. Now, it's way too early to look at that in the month. There's only, a few days of data. But it would make sense to me if a group was trying to defend price that they would try not to flood the physical market. The other thing is that margins are really strong. So just to illustrate this, look at the US data last night. US runs are up, I think it's 900 KBD year on year. Like, it doesn't look like there's a turnaround season in the US really at this point in time. Pad 2 especially, massive. So margins are really strong. And the question is also, China is another question. Are they going to buy a lot more crude based on lower flat price? It doesn't look like it. If you look at the Angola diffs and the WAF diffs this week, they've absolutely tanked. So that is not a good sign from a Chinese buying perspective if you consider it an indicator. So I don't know where I go with all this. It's just I think it's safe to say I'm a bit confused.
Yeah,
I feel like I've missed something, or the price is wrong, and both are possible.
fair enough. Look, I think this has got kind of time to play out as well, right?
Yeah.
Over the next couple of weeks. So it could be a timing element in that. But certainly kind of what we think on the fundamentals should be happening is certainly not playing out in that physical market. Do you have anything else to add kind of from the news side?
No, not really. I mean, just to add on to that, because it's just so many, it's very difficult to boil this down into 1 minute. But obviously, all the oil and water stuff, it does take time to hit onshore inventories. So the first step is the oil and water.
Yeah.
A lot of it is coming from, it seems like it's the US, Venezuela, Saudi, Russia, Iran, others. It all makes sense. It maybe, as you just say, is a timing element, and maybe by this time next month, we've seen it build up in onshore inventory, and that's when Brent can really decline. And I'm still convinced. Look at the US data last night. Sorry to go on another rant, but I feel it's the most important topic, isn't it? If you look at the US data last night, I'm still quite convinced they're building stocks in a normal seasonal way finally, but they're massively up year on year on runs. They're massively up year on year on net exports. So, and you look at the supply numbers, the implied supply numbers are super high. You know, it looks bearish. It's just that the outright inventory level in the US is not that high yet.
Yep. I think that's still got time to go as well. Okay, then, shall we move on to our next segment? I'm quite looking forward to this, actually. So, look, we're going to change things up a little bit today and let us know what you think about the format. So, we're looking at a few spreads and trades that feel a little overextended or certainly out of line. And we're going to break down the backdrop, the pros and cons, what's worth watching. So, Neil, June, why don't you kick us off with the Brent-Dubai swap on crude and what's the setup there?
Okay, I'll take this trade first. The idea is to sell the DEC Brent-Dubai swap or the BDSS for short, currently looking at about 5 cents per barrel. Let's think about how the Dubai market has been. We have seen a substantial weakening in Dubai after weeks and weeks of unexplainable strength. Right now, Upper Zakum premiums are barely 50 cents per barrel. They were at $3 per barrel just 30 days ago. So it makes sense that Dubai is currently weaker, as most of the marginal supply growth since summer is, is AG and mainly the OPEC plus barrels coming out, and most recently a more flood of euros. On top of that, we haven't seen Chinese buying as strong as it was. Of course, we know the slightly more than a week of Golden Week buying impact or lack of buying is probably also negatively impacting Dubai right now. We are expecting the Chinese to come back from tomorrow. And right now, for this trading window, in October, we are looking at DEC loaders buying window. Some point to note is every year, end of the year, many Eastern refineries will be keeping an eye on their year-end inventory to 31st of December to manage working capital. They will therefore be a bit more careful about looking at incremental stocks, aside from China's stockpiling story. So it's actually bullish Brent over Dubai currently, but there's already been a confluence of bearish pressure for Dubai right now.
Fair enough. Neil, what do you have to add into this one?
Yeah, I think we can look at the Arbs, and for sure the thing that is, let's say, something that's going for Dubai at the moment is the fact that there's been this massive step change in the west to east Arb versus where we were a month ago. And of course, the fact that US exports have been quite high in the weekly data, that's a result of the fact that US Arbs were so open, 6 weeks ago? And that picture has now changed as well. So there could be a lot of pain in Dubai just now because it's hitting all this US oil. And that picture might change then because the west to east Arbs are now closed, and presumably in 4-6 weeks that will also be felt in the Dubai market in terms of less competition from the west. And you can see the result of that just now. So if you look at the WAF dips, as I said, the WAF dips are absolutely tanking. That's possibly Golden Week related, or it's possibly related just to the relative arbs have changed, right, June? I mean, it's difficult for us to actually say what is underlying here. So, all told, that's bearish. Brent, the one thing I wanted to just point out, and maybe it's just one of these shower thoughts. Sorry to put that picture into your head. Maybe next week I won't use that phrase. Talking about the OSPs, right? So Middle Eastern crude is expensive in Europe just now. Maybe that's actually a boon. Maybe that's supportive for Brent. And that's an element I haven't really considered that much and until the last week or two. Against that, look at WTI into Europe. WTI is now super cheap into Europe. I think 40s is overvalued. I think you'll take us through that later June as well, but 40s looks too expensive now. And TI looks mega cheap into Europe, but kind of closed into Asia. So, I don't know, mixed on the arbs, but I would say there's two bearish points for Brent, one bullish point maybe. And the bullish point is kind of not that.
Shaky. Yeah, it's on quite fine ground, to be honest. Okay. Yeah. So wrapping that up then, June, what's your thoughts on this one?
So on the whole, the BDSS has already done enough to close off the ups. i.e. it has risen quite a fair bit over the last week. The market feels generally long and longer, which means west of Suez is still the length that globally needs to get cheap. So I think we ought to sell BDSS for now, but we did see a very strange Brent spread recovery this week as well.
Yeah. Okay. Well,
maybe that's a good entry point. Maybe that, the fact that Brent is confusing us a little bit, maybe that means there's more money to be made by selling Brent relative to Dubai.
Fair enough. Okay. Well, we're going to follow this one kind of over the next couple of weeks and see where we get off, I think. So let's shift to gasoline then and the Transatlantic arb. So sitting around 3.45 cents a gallon. It's not exactly straightforward, to be honest. But look, what's behind the disconnect? Which one wants to pick this up?
Yeah, I'll take us through the basics. So it's the TAR for November, I think we would do now. That's, as you said, 3.50 cents per gallon. So the thing is, historically, we're in a very strange place. We've had this massive EBOB rally.
Yeah.
And we have started to cool now to the extent that the ARBs have started to normalize. June's going to take us through that in a minute. We've already had a 2 cents per gallon move on the November, increase on the November swap, basically, since the start of the month. The sort of fundamentals backdrop is a bit odd as well. So the sort of US PAD 1, PAD 3 stocks, they're not super high, but not super low. They're a bit lower than last year. There is turnarounds ahead. We did see a bit of a shift higher in yields as well. Maybe that's related to sort of winter spec. And there's more builds ahead of us. So it doesn't look like a place where the TAR needs to massively correct to open up the ARB picture again, let's say. But the big unknown on the EBOB side is obviously Dangote, and that's just, flipping back and forth almost daily. We were talking to some people in the market about, maybe they need to import into WAF again over the next couple of weeks. And again, it's this picture where it's a risky trade because this Dangote is just this piece of cake that doesn't work, right? Yeah. And it is moving the market massively.
Weekly, I should say. Weekly. Yeah. Let's be fair. June, do you want to take us through the ARBs part?
Yeah, we can. For our ARBs dashboard, we have been seeing ARA looking more competitive in a few LATAM destinations like Brazil and Ecuador against Houston. So that's actually bearish, the TAR.
Yep.
And that hasn't been the case for quite some time. On the other hand, we have Singapore and AG barrels still competitive against ARA in, for example, South Africa, and that's TAR bullish. So a mixed bag there.
Fair enough. So on the basics, we're a little bit bearish, muted on the ARBs. Neil, wrap this one up for us. What are we placing?
I think we're neutral, right? We think it's an important. I think it's an important one to say. We don't see a clear trade. It's obviously a very disconnected relative price setup just now, and we're getting lots of questions about what to do on it. I don't think we have a clear picture. It doesn't look like the US needs to regularly open up the TAR or the ARB into New York just now. And just to note as well, the Naphtha ARBs from Europe and the Med, from Northwest Europe and the Med, are open to NYH to New York for local blending as well. So, and I think we're neutral, and we're it's also just too beholden to the big stuff just now.
Fair enough. So we'll keep an eye on the headlines and watch the ARBs on that one then. Okay, on to Naphtha. East-West is flying high at $30. June, overdone or justified, do you think?
Let's start with the basics. From the seasonals information, North, East, West, Naphtha is currently at its peak. So it does look highly disconnected. And the strength seems to come from a fear of naphtha shortage in the east due to Russian refineries coming under attack, and also the peak turnaround season in the Middle East. But something to bear in mind, the steam crackers in the east will be starting their turnaround season around November. So that is actually fundamentally less support for MOPJ. So on top of that, we've got LPG, which is very cheap into petchems now. Pro-Nap East is at about minus $91 per ton, and I believe it's like when we see LPG switching into naphtha, it's usually at the minus $60 per ton.
Yeah.
And so I'm seeing clear weakness for the east. On the west side, petchem margins are in the doldrums. Ethylene and propylene prices have fallen, and that's limiting naphtha demand in the ARA and putting pressure on the physical premiums as well. Time spreads went negative last week, but has since recovered to plus $2 per ton levels. So maybe we have already reached the floor in Western weakness.
Okay, so fairly bearish then on the basics. Anything of interest in the ARBs that we're seeing?
Yeah, I'll go through. So, and there's just one I wanted to add, and obviously for the last 2 weeks or more, the ARBs from the Med into the East have been super, super open. And we know that flows are responding on that one. I find it just quite funny that, okay, petchem margins are a bit weaker. I find it kind of funny that naphtha in Europe is actually quite so weak, given that there's this massive ARB incentive. We're in the middle of turnarounds. It just feels like it should be slightly stronger. And something I mean, I might be talking complete nonsense here, but I was posing it to Phil and Jorge earlier last week. Has this actually been a problem with the gasoline ARB? Because the ARA gasoline ARBs have been super shut for weeks. And I wondered if that actually has a knock-on impact on naphtha blending for export. And I think there was a sort of mixed response from the guys. I'll try and get them to come next week and actually give us a firm answer. But and if that had been true, that picture is changing slightly in the sense that some of the ARA gasoline ARBs are opening up as well. So I guess that is, again, going in the direction of Europe strengthening against Asia, if true. So I think we have a fairly clear picture that Asia's weakening and Europe has got some bullish impetus.
Okay, I'm keen to kind of pick up that point next week with you, actually. So let's get either Jorge or Phil on the call, because that's quite an interesting one in terms of the lack of demand for naphtha kind of into the gasoline blending pool potentially. Okay, so in that case, wrapping this one up, what's the trade and what are we putting on?
I think the trade idea is solid, that the East-West, November East-West naphtha should be a sell. But it does feel very dependent on Russian refinery attacks continuing. And we have seen a bit of a slowdown in the recent week. So, something to watch.
Okay. All right. Let's move down the crude tower a little bit then, and we can look at distillate. So ICE Nov-Dec has been hammered, let's be honest. So Neil, time to buy this dip?
I think so. So we have been saying it for probably a week. Didn't work out yet. That's fine. Didn't have a huge theoretical drop down, and timing's always difficult. But it does feel like there has been a lot of pain. If you look at the Oct Nov, we're approaching expiry now. The Oct Nov spread for ICE gas oil is now under $4 a ton. Nov-Dec is under 10. I think last week I talked about it at roughly 11. Nov-Dec was a buy. It does feel like we're oversold, so June could take us to the ARB picture, but I think we can chalk the major prompt weakness that's filtering through down the curve to the fact that all the ARBs into Europe were open a number of weeks ago, including TA, from Pad 1 and from Canada.
Yeah.
I think that's what's causing the prompt weakness in Europe just now. And that picture can and will change. And as June will take us through, the ARB picture is now starkly different. And the other thing maybe to add is the US data, I think, is looking slightly more supportive. So if you look at the yield picture in the US Pad 1 yields in particular are down a lot, so local supply is declining there. The rapid build-up in US stocks in Pad 1 and Pad 2 and to a certain extent Pad 3, those have stopped and are starting to reverse. And I think the trend is very important. So if people saw last month rapidly building diesel stocks in the US, that scared them off. But that is now looking slightly different. So that's, I think, a nice bullish setup to a certain degree.
Okay. Jim, what do you have to add?
When we look at our ARBs, all ARBs into Europe is quite closed. US Gulf Coast ARBs to Rotterdam is very close on freight on TC14. But this is starting to soften now from a TC14 point of view. Picker ARBs are pointing very east at a very large premium to the ARB to Europe for the first time in quite a while. And for jet, with the El Segundo refinery fire last week, the ARBs are very open from Asia into LA. And generally right now, Asian jet is strengthening from seasonality point of view for winter demand. And we already flagged this weeks ago as a potential rescuer of Asian diesel. For Chinese diesel exports, they look like they are easing compared to early September.
Okay, so this sounds like a bit of a timing issue then in that case. So the ARBs, as you said, do show kind of a little bit of a different picture. So we shouldn't see kind of the mass bills that we've got. So who's going to wrap this one up? I think we kind of know the answer.
Yeah, the answer is to buy Nov-Dec Gas Oil. I mean, James is also very bullish, unsurprisingly, and no, it does look like also from the east-west perspective.
Yeah,
I know that Chinese exports are down. That's usually quite an interesting signal, but it does feel like all ARBs are very, very open into Sing as well. Also from North Asia, SIC has got the biggest premium to Sing over Europe and seen in weeks and weeks and weeks, months. So it does feel like Asia looks too strong. And also from the East-West perspective, it seems like ICE needs to strengthen, relatively speaking.
fair enough. Okay. All right. I think that takes us through kind of 4 trades that we've worked through. So why don't we just finish off with the rest of the barrel and do our quick fire round. So this is a bit where we stop over analysing and just call it as we see it. So what have we got left? Fuel oil, freight, crude, maybe? Let's go.
I'll do Forties if you like, Jane.
Sure, I'll do fuel.
Forties is overvalued. There's the TI Afras into Europe, into Northwest Europe, are extremely cheap, even despite the TD25, which is still pretty strong. And you got CPC arbing into Northwest Europe in our numbers for the first time in ages. WAF looks extra cheap. Margin basis, 40s is at the bottom of the pile out of a bunch of light crudes in Europe. Just looks overly strong. So I think that needs to sell off.
Yeah, okay, fair enough. That's very, very clear. Quite a lot of crude heading to Northwest Europe or Europe in itself. So June, fuel oil.
All right. In Malaysia, the refinery there, Pengerang or PREFCAM or Rapid, however you want to call it, both the RFCCs are still down. And the maintenance is now heard to be extended till second half of November. So with that, Sing 0.5 physical is back in contango with spreads just around flat. Our projected forward blend margins after tank costs are now also back to flat to slight negative for North and Dec after about a week in positive territory. The mid-sulfur range material now looks more workable into the high sulfur pool again, with high sulfur premiums and spreads faring a bit better.
Okay, brilliant. I'm glad you took us through kind of the refining names. Yeah, times 10. Brilliant. Neil, you picked up on TD25 earlier, so why don't we just wrap up with freight?
Sure. TD25 spot rates have bottomed out in the low 150 world scale. And to be honest, it still looks like there's going to be a bit of a rebound. Afra supply looks relatively tight in the US Gulf. TI econs are extremely good into Northwest Europe. So it just seems like October fundamentals are strong for TD25. Yeah. So think about that for TI Brent as well. TI Brent paper already back out to, where are we now? Minus 425. Lovely. So those two things correlate quite well, TD25 and TI Brent, for obvious reasons.
Yeah, of course. Anything on the clean sides?
Well, TC14, should I cover that? Okay. TC14 have started to soften after a strong September rally. And we've got these new signals for freight called FSD, Freight Supply and Demand. This signal is pointing to lower fair value around 193 world scale as the 7-day window length builds despite steady inquiry. LATAM ARBs still remains the most attractive demand outlet, keeping a short-term floor for the spot rates, while November TC14 paper looks broadly fair.
Fair enough. June, can you finish us off with the TC2 as well then in that case? While you roll with the cleans.
Sure. TC2 rates is continuing to ease with the Sparta FSD pointing towards 107 world scale as increasingly long tonnage counts begin to weigh on sentiment despite improving up margins. The forward ups remain mostly open. Nov and Dec TC2 paper value looks fair at 137 world scale, but the spot weakness could pressure paper near term, and we are expecting the spot November paper spread to widen.
Okay, thank you very much. I think there's a few trade tips in kind of the quickfire round as well this week, which is great. Okay, anything else from anyone else? And if not, I think we can probably wrap this up for this week.
No, we're out of gas.
Fair enough. So in that case, then, that's a wrap for this week's Sparta Market Outlook. So we've dissected the headlines, challenged a few assumptions along the way, and hopefully given you something to think about before you place your next trade. So if you've enjoyed the new format, let us know. We're always tweaking how we bring the market to life for you. So look, thanks both Neil and June, and until next time, keep your spreads tight, your data clean, and your outlook sharp.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.